Thanks everyone for joining us tonight. My name is Josh Shine. I have with me, as you hopefully see on your screen, Jessica Franta, our head of investor relations. And the two of us are happy to join you, or happy to have you join us and welcome you to our Effortless Real Estate Investing webinar. I'm the CEO of Trius Lending Partners. Our founding partner, Steve Bond, I don't see him on here, but sometimes he's listening in the background somewhere. But I do see a lot of familiar names. So hello to a bunch of people who you know who you are, but nice to see you. And for people who we don't know, nice to see you as well. Nice to meet you as well. We hope over the next 20, 30 minutes and whatever time for Q&A, we'll allow as much of that time as needed to be able to talk to you a little bit about Trius Lending Partners and talk about our newest fund that we are in the process of rolling out right now involving real estate investing. So we're going to spend a few minutes talking about that. Hopefully we'll be able to learn a lot. And as I mentioned, questions and answers, just a little bit of housekeeping here. On the bottom of your screen, hopefully we're all familiar with the Zoom world over the last few years. There's a Q&A button and there's a chat button. The chat button, feel free to use for anything to communicate with other people who might be other attendees and or to communicate with us with any other sort of comments you may have. But we'd love to keep all the Q&As, if possible, saved in the Q&A section. So that's the place to go to actually ask the questions, is that Q&A button. We can track it better and make sure we can address as many of the questions as possible. My standard line, there's no bad question, there's no wrong question. We're here to answer the questions. That's literally what this exists for, is to be able to have a forum for you to ask myself, Jess, anything that we do, Trius Lending, real estate, anything we cover, anything we don't cover. And if we didn't explain it clearly enough, please raise your hand, reach out, go to the chat, ask it again. We have the time. We want to take the time to make sure that when you leave tonight, you have learned a good bit about us, a good bit about the opportunity, a good bit about what we're doing, and most importantly, had every and any single question answered. Okay, it's really important that we accomplish that for tonight. I would say that's among our top goal for the night, is answering every and any question you have as deeply as we need to get into it. If you get really complicated, which we're fine doing, we might say, hey, let's take that question offline, and we might do it in a separate conversation after the meetup, or sometimes we have a call, an email, or a follow-up the next day when someone wants to dig or dive deeply into a topic. So having said that, let's kick it off. Okay, next slide, please. Obviously, you already know I'm Josh Shine. This is Jessica Franta. Thank you. All right, let me start with an overview of Trius Lending Partners. Obviously, we have a lot of new people joining us here, and we're really excited for you to learn a little bit about us. Some of you already know about us, so it'll be a little repeat. Trius Lending Partners was started in 2003. Steve Bond, our founding partner, started it. Steve had been in another career, had a whole nother life. And for those of you who know Steve, know he's not someone who can sit around and do nothing. It's just not his personality. So he got into mortgages, got into mortgage lending, and started lending money to real estate investors. People were coming to him post the .com meltdown, just looking to get into real estate and say, hey, I want to buy a place, I want to flip a place, I want to invest in a real estate property, et cetera. And there weren't great products on the mortgage side to do it. It wasn't so easy to do. So he started lending his own money. That's the long and short of it. That's literally how this all started. Fast forward, I came to him about 7.5, 8 years ago, after having been in the mortgage business myself for almost 20 years at that time, and said, I'd like to get out of the residential side of mortgages and get into this investor side, this private lending money side. Private lending exists, I'll briefly describe it because it's important to understand what our current core business is. It exists for providing easy and quick access to funds to buy rental properties and or commercial properties or any type of investment property for flip or for hold, with or without rehab, okay? If you go to the bank, it takes a little time. It's got a lot more paperwork. It's more complicated, more complex. People come to us, today's Wednesday, people come to us on a day like today and say, I need to close by Tuesday. I need to close by Monday. We've had people come to us today and say, I need to close tomorrow. For whatever reason, a rush, a last minute deal, it fell through, they need bridge financing, whatever it might be. So these are 6, 9, and 12-month loans that are being given to borrowers for the short-term bridge of getting that property stabilized for a flip or for rental, or until they might refinance into other financing. So as the company grew, with Steve, with myself, with Steve's son David as well. And then with the additional team as we built it out, Steve Sless, our COO, Jess, some other people we have on the team as well. We now have over $100 million in loans out. So that's private friends and family money that we've raised. We do not have institutional capital. We don't have banks behind us or Wall Street funds behind us or anything like that. That's friends and family money in the local marketplace in the greater mid-Atlantic region. Some are now in Florida, retired down there, but that's most of our investors are within those two areas. And they have had money with us, some since 2003 when Steve started. He very quickly started growing and had more loans than money and started going to his friends and family and asking them to invest money. And since that time, no one's lost money with Trius Lending Partners. And that's really sort of our big claim to fame, is the fact that people have been with us for years, earning really nice returns for many, many years and never lost any money doing that. And that's not something you can say in a lot of other investments. And these are investments in a first lien mortgage, which is in real property, as opposed to a stock or a startup or whatever it might be. So we really think it's a very safe investment, and our track record has proven that as well. Most of our investors that start with us stay with us. So that's really key. As far as the loans we get and the loans that come into us, our reputation, our brand has been what we've done to build that up. And we've been growing at a really nice pace. Not crazy growth, slow, steady, consistent growth, but every year we have been growing. We've won some awards for that and really built a really strong reputation for being ethical, honest, transparent, and just doing right by people, telling them when it's not a good deal, telling them what we think of the value of their properties, and just taking care of our borrowers who are borrowing from us, taking care of our investors, and certainly taking care of our employees as well. So as we continue to grow the company, we've always focused on sort of our core values, and these are posted around the office. Everyone who wants to come and visit is welcome to come and visit our offices up in Towson at the intersection of Charles and Kenilworth. We have a beautiful space here, and we have our core values posted on the walls, posted on everyone's desks. Great communication, growth mindset, relationship based, and willing to get the job done. And that really summarizes just who we are as people, who we want to be with our clients, with our investors, and how we want to run our business on a day-to-day basis. So as we've expanded, we've said, you know what, we see a lot of properties, we see a lot of opportunity out there. Maybe we should look at maybe doing something a little differently, and expanding our business to something that still is in our wheelhouse. So I'm going to let Jess come talk about some of the data and some of the details around why we're heading into this and the opportunity within the marketplace.
And thanks to everybody who is tuned in tonight. We appreciate your time. We know you're busy. Real quickly, a little bit about myself, just because it actually will sort of translate to the story of Trius and really specifically single family rentals. So as Josh mentioned, I am the investor relations manager for Trius Lending Partners, but I came by the way of being actually a borrower. So I know some folks out there listening in are already familiar with me and my story. But my husband and I had actually grown our own rental portfolio as individuals. And over the course of about 7 years, we got up to 21 units. And during that process, we'd actually kind of outstripped our own personal funds and cash. And I'd sought out a private lender, came upon Trius Lending, and did about 10 different deals with Trius as my lender on that before actually coming to work for the company. So several things. As a borrower, I can speak to the value that our company provides to borrowers. And then as an individual, I guess by way of a testimonial, I can speak personally to the power of single family rentals. They changed my family's life, personally, financially. So I am a big believer, and I guess I warn you with that in mind. I get pretty excited about this. Josh makes fun of me because I have a tendency to sort of nerd out, kind of geek out about some of the details, but it's powerful. It's what we do. And so it's just really, really exciting. So with that in mind, what Josh mentioned, I think one of the key takeaways from kind of his intro is this is our core business, right? This is exactly what we do. We look at thousands of single family homes every single year. And more specifically, we look at them through the Mid-Atlantic market. So the next kind of a little bit of what we're going to talk about, like the state of single family homes and rentals throughout the United States. I kind of want to highlight that we are hyper-focused on the Mid-Atlantic region. We remain hyper-focused on the Mid-Atlantic region. And we're super aware that you can take kind of national trend sets, and they will differ based on region. And I'll kind of get to that. But I think it is interesting because, single family housing, single family rentals, it's sort of something we're all anecdotally, like day to day, kind of aware of, and some big broad themes amongst that. Listen, there's a housing shortage. Period. There's not a lot of debate. There's a lot. It's actually even kind of entered mainstream politics, mainstream news. Like it's just something that I think we're generically aware of. Specifically amongst kind of that shortage, there's a number of factors influencing it. Population growth, immigration's actually really been an interesting sort of surprising pressure force on household formation. And so that's kind of caused further shortages aside from just what we would kind of call like, standalone, US population growth. Um, Also, we've seen a lot of job growth and income growth. And what you see is that when you have job growth, income growth, and also like Gen Z entering the market, how people live is also changing. And so while we have had a great number of multifamily units coming online in the last several years, we all see it driving down the road. You see a lot of larger apartment complexes. That doesn't actually mean that's where people want to live. And there's an incredible amount of data behind that. We cite some of our sources at the bottom of this. And again, as Josh mentioned, if anybody ever wants a really detailed conversation, I'm super happy to do
Dr.
it.
Jess.
Yeah, call me. Please call me. And we can kind of dig into that. But we're seeing sort of how people want to live change. And in addition to the simple household formation, they want more bedrooms, they want standalone single families. And again, this is kind of influencing the shortage. So you can have overall units coming online in the form of multifamily, but it might not actually be what the consumer wants. This is, of course, in terms of rental growth, so not just the demand for single family homes, but the aspect of actual rental growth. I mean, it's under an incredible amount. The cost of owning a home is under an incredible amount of pressure. Specifically, we all know that home prices have surged. Households are cost burdened. So even though they've seen, a nominal rate of income growth, they aren't necessarily feeling it or experiencing it. And again, anecdotally, we're all super aware of this. We feel it at the grocery store, we feel it at the gas pump, like whatever way we're feeling it personally. And again, it's probably not really a surprise that it's impacting sort of individuals' ability to in how they seek shelter and what they can do. So mortgage rates, of course, and obviously those rates have increased the cost of home ownership, insurance, and property taxes. Property taxes are sort of this interesting delayed factor. So you had incredible amounts of, growth in terms of home prices over the last couple of years. Well, obviously local municipalities are taking full advantage of that. And it's a delayed aspect that affects the cost of home ownership. And all of this together is really making single family homes harder as household formations are creating. So we feel that there is, in some ways, unfortunately, but definitely an opportunity within that. So that's like the broad trend statistics nationally. If we could kind of go to the next slide, more specifically, and this slide again kind of backs up that, hard data, obviously after the financial crisis, 2007, 8, 9, you just see this massive, drop off in terms of the build of new construction homes, and it's never recovered, just never. And, there's some really good predictive think tanks for housing at a national level. And quite simply, if you look at building permits being pulled, because we can pretty much forecast 12 to 24 months in advance, like what the inventory is going to come on and where. Not only are building permits not being pulled to meet demand and to overcome the shortage, they're actually going to worsen. And moreover, what's kind of interesting, and it'll get to the next slide, is that homes aren't necessarily being built where they're needed. So, and that's kind of also an interesting story. And again, we've all sort of heard it, right? Everybody's moving to Florida. Austin, Texas is on fire. Let's go to Nashville, like all these things. Those are exciting cities and they are. I'm happy to be where I'm at, but they're exciting cities, and they've seen an incredible amount of pressure in terms of home price appreciation, property taxes, and all that. They have seen some accompanying new starts, new builds come online. An area that really hasn't and continues to be in a big shortage, our area, the Mid-Atlantic region, right? So Maryland, Virginia, and DC. That's why we love it. It's not exciting. It doesn't have these great massive increases, but really steady appreciation coupled with really sound fundamental economic fundamentals, right? That being said, although Maryland, Virginia, and DC are not the Floridas or the Austins, you actually see some still pretty strong and steady growth. So on this slide specifically, you'll see Maryland from the latest Census Bureau is experiencing actually a 7% population growth. That is statistically significant. Um, and it's buoyed by good employment opportunities, right? And so these areas are obviously, there's a lot of government opportunity, healthcare, education. So really, who is moving here and households that are forming in the greater mid-Atlantic area, they're the kind of households that you want to rent houses to. Similarly, if we can go to the next slide, just dives into Virginia and DC. Again, kind of a takeaway. The funny thing of sort of about real estate is that real estate is always local. So we are a mid-Atlantic lending company and a mid-Atlantic rental, real estate rental company. But we are also very aware that DC is not Virginia, Virginia is not Maryland, Maryland is not either of those. So they each have their own unique characteristics, and that correlates to the cost of home ownership, that correlates to rental rates, that correlates to borrowers and renters. And so I won't get into all the detail and each of these, but the broad spectrum across is that still each and all are experiencing growth. And that is accompanied by job growth, it's accompanied by opportunity, and it's accompanied by the, essentially the market conditions for which we really feel there's an opportunity to buy and hold rental homes. So that's, again, I could get excited and talk for the next 10 minutes, but I should probably stop. But that's kind of a summary of the single family market for housing and rental as we see it, and why we're really looking and excited about this rental fund. Yeah.
Great stuff. Thanks, Jess. I would just add a few comments to agreeing with everything she said. The chart a few slides ago had also multifamily on it, a small slice for manufacturer. Multifamily is a big area for it. For us, we want to focus on what we know, what we have experience, what we have knowledge on, and that's the single family. Single family is sort of 1 to 4, right? So we're not going above 4 units. So 5 plus becomes larger. The single family, we also there's a slice for townhouses in there too. So we would do that as well, single family or townhomes. But the idea is that the multifamily, meaning the towers, the large office rental towers, et cetera, we don't have experience with that. We don't have expertise with that. We want to stick with what we know, and that's always been the recipe for success at Trius Lending Partners. Don't get too big. Don't get, as they say, out in front of our skis, right? Let's handle what we can handle, what we know, what we're comfortable with, what we look at every day, what we underwrite every day, what we fund every day, the relationships we have, the people we have. That's where it makes the most sense for us to get into. For us to say we can jump into 20-story towers that have 100 units, that's just ridiculous. We don't know what we're doing with it yet, and so it's something we don't want to jump into that we don't have experience and knowledge in. So, and that's same for the region. Okay, focusing on a region we have comfort, familiarity with. We may go outside of the 3 states here, right? But the greater sort of mid-Atlantic, as we like to call it, we do touch Philly, York, Harrisburg, maybe some Pittsburgh, heading down southern VA. Maybe we head down a little further into the Carolinas. Generally, we're not going to go to West Virginia. Maybe we go to Delaware in case-by-case basis. And that's what we do for our current lending. So again, these are areas we're familiar with, marketplaces we're familiar with, and that's really important. And on the affordability side, just briefly to touch on that as well, if you have young kids or know anyone who has young kids or graduating college, no one can afford to buy a house. That's not even considering. Young people get married, they cannot afford to buy a house. In the mid-Atlantic region, they have a decent shot, a better shot than some of the cities Jessica mentioned, Austin or San Francisco or LA or New York or Boston. You can't afford to buy in any of those areas. So it is more affordable here overall, which we think creates good opportunity for us buying places. But still, renting is key because you still can't afford no matter what. And so renting is the more efficient way of handling how to sort of start your life and grow your life. And for some people, forever. Maybe better to rent than to buy. And the final comment I'll make on that is those hot areas, they're hot when they're hot and they're not when they're not. I mean, so Today, literally on CNBC, if you had some time, I'm sure they're replaying it online. Whole story about the Florida marketplace, the Florida condo market, the percentages of sales down. They didn't talk about numbers as much, 30, 40, 50, 60% down in the market. Number of reasons for that, but a lot of it is flood insurance, cost of living, saturation, et cetera. I've heard stories about Austin as well, majorly slowed down from the hotness during COVID and sort of coming out of COVID. So just food for thought on that. So next slide, please. So let's talk about what we're here for. So as we have grown the company and said, well, what else can we do and how can we continue to evolve the company, grow the company, stay in our lane, stay in our knowledge base, we said we should be doing some real estate. We're working with people all day long who are looking at deals. We have people send us deals and have for years and years. When Steve Bond started, ever since then, when I started with Steve, people would say, hey, I've got a portfolio to sell. Would you guys be interested? I've got a few properties to sell. Would you guys be interested? And we said, no, we really want to focus on a core business. And that was the right move. That has been the right move. Focus on what we know. I would argue, and I think there's a strong case to be made that we've done a really good job with that. We've taken care of our clients, taken care of our investors. We have a nice, robust business providing loans and financing people flipping homes or buying properties for hold as well. But we have the connections, we have the networks, we know the area, we know the market, we know the sellers, we know how to finance stuff, we know how to do light renovations, which I'll get into in a minute. So we said, why shouldn't we get into this as well? The other thing we ran into and continue to run into is our investors. I mentioned over $100 million in investors that are in the mortgage fund and or note investing in our mortgages. And many of them have said, I'd love to get into real estate. I'm too busy. I don't have the time. I'd love to do what you guys offer, but I just don't want to deal with the call in the middle of the night or the standard story, the toilet overflowing call on the weekend that you have to deal with property ownership. And so we said, we could offer this. And that's what this comes from. So the idea is believing in real estate, which we believe in, believing in a market, which we believe in, knowing that with real estate, it's only a matter of when you're going to make the profit, not if you're going to make the profit. If you're in real estate long enough, you will always be successful. And I don't say that with an asterisk on it. It's a matter of how long it might take, depending on when you get in and when you get out. If you got out before, if you got in 06, you didn't have a great 07 and 08. But talk to people who sat that through and survived and wrote it out. They are happier than they ever could have imagined because the market came back better than ever. So patience is key in real estate. And if you talk to people in real estate, older people in real estate who are very successful in it at maybe later years, there's one common thread they all say, I wish I bought more and I wish I bought more sooner, because they know time is the best key to real estate investing and getting in early is the best key. And doing it, just taking action, not trying to time it. And so we're not trying to time it, although we think it's a great time to get into real estate. We're not trying to time it with rates coming down, although I do believe in the next 18 months, we believe in the next 18 months, rates will come down. The Fed's definitely dropping it. But just as a side note, the Fed has dropped rates in the last, 3 weeks. Mortgage rates did not go down yet. Okay. They actually went up post that Fed drop. That's a whole nother conversation for probably another 2-hour webinar. But having said that, we believe it's a great time, but we're not trying to specifically time it. But this is a long-term commitment into this. That's the difference with our normal mortgage fund investing. That's a 1-year commitment. This is a 5 to 7 year investment period. Our plan is to raise $20 million from outside investors, friends and family, similar to what we've done successfully for many years. Take that money, buy these single family type rentals, scattered site throughout the greater mid-Atlantic region. That might be one-offs. It might be right now, we are looking at a 95 unit portfolio, 95 different properties around Baltimore County, okay, that are all rented, some with Section 8, which is government subsidized, some are not Section 8, but they're rented and stabilized. The person has held them for a long time, and this person is looking to just get out. They're done with it. They just want to be done. They want to take some cash off the table. They may put that into multifamily. They may put that into commercial. They may do whatever they want with that. But time and life changes cause people to sell portfolios, changes in families, deaths, moving, whatever things might cause people to want to sell properties. And that's what we want to take advantage of. So we're going to raise $20 million, take that $20 million, borrow 50% loan to value on that. So we intend on going out and purchasing approximately $40 million in real estate, at an average of about 200,000 per door, ballpark, very rough numbers. We think we'll hold about 200 properties, okay, and hold those for a 5 to 7 year period. We're not going to buy properties that need huge renovations. We're not going to do full gut rehabs. That's not the model for us. Small cosmetic rehabs, generally rehabs that don't need permits, just like an update on some appliances, maybe some paint and carpet. But we're not moving walls or rebuilding anything within the property. Opportunistically, if those come up, we're not against those, but that's not primarily what we're focused on. What we're focused on is time and knowledge. We're not trying to reinvent the wheel or recreate real estate investing. We just believe we can do it a little bit better than the average bear, right? We think with our knowledge, our expertise, our connections in financing, in knowing the properties, knowing the areas, knowing the market, we can do it a little better, a little more efficiently. We've got a full staff, we've got accounting staff, back office staff, we've got all the players and all the people there, so we can allocate costs better than most other people can. And we've got the knowledge base to find the success. So we buy these properties, and we, over time, raise the rents, as happens year over year over year, pay the mortgages down year over year over year. Properties appreciate year over year over year, okay? In our market, because it doesn't have those spikes of Austin, for example, we don't have the downs either of the Austin. We continue, and the trend has been this way, and that chart showed it, in the greater mid-Atlantic, generally speaking, we sort of continuously make our way up with a lower range of highs and lows. But even if it's a low, we don't think it goes very low. Having said that, we believe we're on an upward trajectory right now, that we should see a nice annual appreciation over time. So we believe when all that's put together, this allows people to invest for $100,000 into a long-term investment that over time will create an IRR of between 14 and 17%. Way that's going to work, roughly speaking, and we have more data and we'll do one-off calls with anyone who wants to and explain, is we think there's about 3 phases of this investment fund return. The first phase is the acquisition phase. So we're going to raise the money and go buy properties. We don't believe every property we're going to buy from day one is going to be positively cash flowing. Okay. Might be tight, might be cash flowing for a very small amount of money. So for the first, say, quarter to third of the time, there may be little, if any, cash flow to any investors. The second third, the middle part of our investment period, we believe will start to have a 6+% annualized rate of return. The final third is when we finally have our capital event. The capital event means at the end of the 5 to 7 years. And if we have to, by the way, we could go a little longer if we think that's more beneficial and more profitable and lucrative for the members of the fund. Everyone is involved in a lot of those decisions in the fund. At the end of that period, one of 2 things happen. Generally speaking, you sell the portfolio or you refinance the portfolio and do a cash out refinance. And that waterfall event, that capital event, causes everyone to get a large influx of cash, which then causes that IRR, your annualized rate of return, to end up in the 14 to 17% range. So maybe you had 0, 1, 2, or 3% for the first few years, 6, 7, or 8% for the middle few years. But at the end, it could be 60, 70, 80. We were running some scenarios where it was like 100% at the last 2 years because you cashed out of those properties based on appreciation and value, and you were cash flowing really strongly leading up to that cash out event. And that causes the annualized rate of return to be in a 14 to 17% range. Our projections on that are fairly conservative. We have a conservative model, a sort of baseline model, and then an aggressive model. And as we always do with Trius Lending Partners, we balance all that out. We're very realistic. We're very open-minded. By doing 50% loan to value, that's a very conservative approach. If you researched or looked at any other types of funds that are doing what we're doing, most are much bigger. I don't want to be bigger. We don't want to be bigger. We want to walk before we run. We could be raising $100 million with this. We could be going to the Wall Street guys, just as we could in our mortgage fund, and raise almost unlimited funds, because that's what they're doing right now. They are giving away a lot of money and leading into a lower interest rate environment. They're going to want to put a lot of money to work. We don't want to bite off more than we can chew. We don't want to take more money than we can put to work. We believe 20 million is the right number, allowing us to purchase 40 million in real estate. At 50% loan to value, as I say, we're playing it safe as well. There are many people who would say, let's do 60, 70, or 80% loan to value and get that much bigger. We don't think that's the right move for us. We don't think that's a safe, smart, and conservative move. And we want to be safe, smart, and conservative. So that approach we're taking to play it safe and make sure we can have the best return for investors overall over the long-term period. All the investors in the fund receive a K1, so you're a member of a fund. You get the same depreciation you get as owning your own real estate, proportionally adjusted for your ownership in the fund and the amount of money you invested. You get the upside on appreciation, the upside on cash flow, the upside on rent. And then, of course, you have none of the downside, right? So you don't have the downside of dealing with the calls in the middle of the night, issues, problems, whatever it might be. Someone didn't pay their rent that month, or an eviction, or finding new tenants. We obviously will handle all of that, as well as, of course, the acquisition of the properties. So we believe we have the expertise and knowledge to do this, and to do this well, and to do it profitably. And we believe it allows the average common investor in the Mid-Atlantic, or interested in Mid-Atlantic, to be able to have access to the real estate market here, and the upside with that real estate market, which continues to be extremely strong, and have a really nice, healthy return over that long-term period. Really rough numbers, and again, don't want to get too deep in the weeds here. The way the dollars and cents works is the investment goes in. We're going to be raising money for about the next 6 to 12 months, depending on how long it takes. As soon as we raise the 20 million, we will stop. We raise that money. As soon as we start to have some money coming in, we have $1 million raised right now, and we're going to be buying properties immediately. As we continue to have more money, we're going to immediately be looking at properties, buying properties. There is an actual end to the fundraising, so there's essentially closes out, and no one else can get in at that point. At that point, we've either acquired all the properties, or we may be spending a little more time, depending on the marketplace and availability of buying more properties. Then once all the properties are purchased, which should happen within the next few years after, hopefully not longer than that, could be 1, could be 2 years, then it's just our job to stabilize those properties, work towards that cash flow, work towards that capital event in that 5 to 7 year time horizon. And then hopefully everyone makes money and is very happy and goes about their days with the benefit of owning real estate without having to deal with the hassle of it. So that's sort of the basic summary of it. Jess, anything I missed on there, or any points you want to add to that?
No, through in the back of my head, especially as somebody who's had to manage 21 units and work a full-time job and be a mom, I mean, it is a job, right? Professionalizing, having single family rentals. And I know there's folks on here right now listening that have done it themselves. So I know, it is a job. It needs to be professionalized. It needs to be taken seriously. And I would just kind of underscore that the staff we have in place is, yours truly here leading that charge is not only personally experienced, professionally experienced, and we do take kind of that entire life cycle. So not just the acquisition of the house itself, the correct underwriting, and we've developed some really cool tools in-house to really facilitate that underwriting, but also just the life cycle, so the actual management of it, that we take care of the property, we take care of our tenants, we take care of our investors all the way through until essentially the capital event, either sale or refinance or whatever it may be in that 5 to 7 year period. It's all exciting during the fundraising, but that the work continues, and we're super aware of that. It's actually what kind of personally excites me, as you can tell. So that, and Josh, you talked about it, just kind of an underscore of those who know us well. We are conservative, and we don't plan on changing. We are who we are. And so I was gonna kind of underscore that, but I think that's about it. It's interesting. I haven't seen actually any questions really come up
Yeah,
in the Q&A.
we need questions.
Yeah, somebody asked if we would have this recorded, and the answer is absolutely yes. Happy to share. We do share recordings from like YouTube. We'll send a link. So that's no problem. I guess we just talked a lot.
Please ask away. Please jump into
Yeah.
the Q&A button. Ask any question, big, small, medium, about anything. What else could I add? And just mentioning while waiting see if anyone's got some questions. We would love to have one-on-one meetings, either in person or Teams or Zoom or what have you, or calls, to sort of talk people through it, show people the paperwork, get the comfort level for it. It's open to accredited investors. Accredited investors means there's a certain threshold for income and or net worth. We can go over that with people as they're looking for more information. Happy to meet any additional people if you have anyone else you know who might be interested in it as well. Again, $100,000 is the minimum investment as well. Other than that, I think we've covered sort of most of the A to Z. The way we look at it is now we will have two options for investing with Trius Lending Partners: the mortgage investment, which we consider sort of a glorified bond type of product, right? Fixed, steady return, 1 year requirement. And we're always flexible on that. We tell people that sometimes people need money in or out for emergencies or whatever. So I don't want to say it's a savings account, although we've had some people use it like that, but it's made to be a fairly accessible fund with a fixed steady return with a really phenomenal track record. And this is a little bit of the opposite in that it's not a fixed return. We hope it's a much higher return. We expect it to be a much higher return. And most real estate types of funds are much higher returns. And it's a longer time frame. This is not something that someone can put money in and then decide to take it out down the road. It is closed end. Essentially, the money is locked into there. We'll be providing an enormous amount of information and data to the investors on a regular basis, lists of properties owned, assets, financial statements, et cetera. So we're going to be doing all of that to make sure everyone's well informed. I think we do a really good job with that now. I think we'll be more diligent to do an even better job with that, because I think when you put money into something for this long, you want to make sure you really have a lot of data and information. And that also ties to sort of the Trius way of doing things, which is an open book for everything. Physically an open book, meaning anyone and everyone, and some of our investors do physically come into the office, sit down, meet with us, talk to our underwriter, talk to the staff, look at what we're looking at. We can show them properties we look at, and we will be doing that certainly with anyone who wanted to do that in this fund. And then just phone calls and communication. We are an open book. Jessica, myself, Steve Sless, Steve Bond, the rest of the team, we're available on our cell phones pretty much every day, all day. And we're open to talk to people. And there's no question we won't address, won't answer, won't handle, and won't communicate with someone. So that's really the benefit versus some of the larger type of institutional places, or maybe a public REIT where you might be investing through your stockbroker or whatever. You have no idea about anything. You have no involvement of anything. You're just literally putting the money and hoping that they know what they're doing. We're here to sort of talk and walk you through it and make sure there's a constant comfort level. And quite frankly, listen to feedback and advice, which we're always open to doing with everyone as well. I see some questions here now.
Yep. We've got one in chat. We've got three. The first one came in is, how is this different from a REIT?
So it's funny you say that. So I don't want to get too deep in the weeds here. A REIT has some similarities, obviously many similarities to this. There's some different tax and legal structures with a REIT. And we believe with our attorneys, the way this was structured, that having it just as a standard fund added the most flexibility and ease to what we were doing. The regulations for a REIT get a little cost prohibitive depending on the size of it. And so that's one of the reasons we decided not to do a REIT on here. As we get bigger, we may or may not change our mind on that. So we just talked to our accountants, our lawyers, and they said, we believe at this size, again, we're starting off a little smaller, this was a more beneficial way to do it. At the end of the day, there's not that much of a difference. There's some tax and ownership structure portions of it. Certain numbers of investors, certain ownership percentages with a REIT. That gets a little complicated, how many people can own how much percentage of it. And we just thought it was easier and cleaner to keep it in the fund model here. I'm happy to take that offline and dig deeper into that if you want to as well.
To answer, I see a question about what documents to send to request max loan to value for a multifamily. I think that's more actually like what I used to do kind of as a borrower. So that's more of a DSCR, debt service coverage ratio kind of question. And really what you'd be looking for if you're trying to actually get a loan from Trius in support of like refinancing out or something like that for multifamily is kind of really provide rent rolls and all that, essentially a holistic look at the property. As a side note, when they even, funded my deals, we look at not just the property itself, but we do look at the borrower as well. So we can take that and we can grab your information and also have somebody reach out. Yep, that's easy.
I was going to say that for Pedro. We just popped up on the screen here, just our contact info. We're still going to take questions and answers, but just, our contact info, pretty easy, invest@triuslending.com. Obviously, our website's on there. That's Jess's direct number for some reason. My poor Jessica. But
Y'all don't want to know my phone on any given day. This next
a lot of calls.
question,
Yeah.
it's a lot. This next one is actually probably the most common question we've gotten. So
Yep.
is there any, and then we'll go to the chat. I see
Yep.
all in the chat. Is there
Yep.
any advantage for early investors versus those who invest 12, 18, or 24 months later? Do you want to take that one or?
Yeah, sure. Yeah, Jerry,
Okay.
good to see you on here.
Yeah.
Hope you guys are doing well. Yes is the short answer, right? So what happens in a fund like this is timing matters, right? So getting in early means as the investments we made and the investors have a mark-to-market adjustment that will happen on a regular basis, generally quarterly, with our accounting firm. We work with Rosen Saperstein Friedlander, RSNF. They're about 150 employees. They're a nice sized firm here in Towson, well known. They do our audits for us and all sorts of work for us. We will be, and they will be involved in constantly marking to market the property values and the investors' values of their investment. So if someone gets gets in and comes with us and says, "Hey, guys, I'm going to give you $100,000 tomorrow on October 17th," great. We buy a property next week, the end of the month, whatever it is. That property hopefully starts to get stabilized, starts to appreciate. And then someone comes in a year later toward the end of our fundraising cycle. Well, by then we may have bought a bunch of properties at that point. We may have one or two cash flowing, one or two that we're working on getting cash flowing. Maybe we did a little bit improvement to another one. Maybe one we bought really low and it's gone up a lot. So I don't want to get into the complexities of it. We can take that offline. But yes, it is adjusted for the person that comes in a year later. They don't get the same benefits with regards to essentially it's how percent ownership and how cash flow works for the person who came in a year later. Because the person who came in a year later might get cash flow maybe quicker and sooner than the one who's been sitting for a year waiting. The one who's sitting for a year waiting actually is better off because they were in earlier. So earlier in the fund is going to be better for appreciation, better for cash flow, better for the ownership percentage as it's adjusted with multiple people coming in. It gets a little complicated with some of the math, spreadsheet, et cetera, but that's where depreciation is going to be impacted and overall ownership, cash flow, and percentage and return, quite frankly. The best returns are going to be earliest in, first in. It's not going to be bad return for the others because you're not coming in 7 years later. If you were doing a 20-year fund, the impact would be much bigger. So I want to say this too, the impact will be there, but it won't be like this huge impact where someone who's in the first year is going to get a 25% annualized IRR and the person who's in a year and a half later is going to get 10. It's not like that, but there will be fluctuations and earlier will be the better and smarter way to go. No doubt about it. No doubt about it. Ari, I see your question there. Good to see you. Haven't talked to you in forever. Thanks for coming on here. Once all the properties are purchased, how will management and maintenance be paid for? So, great question. So currently we're outsourcing management. We're going to be outsourcing management to someone who we currently do work with. As a side note, right now, we currently have on our own, not in the fund, but on our own, about 39 rental doors right now. I say about because I'm not sure if it was 40. I think as of tomorrow, it actually becomes 40. So we've been dipping our toe into some of these rentals and doing some of this. So we're not going completely blind here. We have rentals of cash flow. So we work with an outside manager on that who's been phenomenal. I'm not going to lie, it took us 3 managers to get to the phenomenal manager, but we now have the phenomenal manager. We intend on with the rental fund staying with the manager until we get to the size. We believe that size is about 65 to 85 doors where it makes major economic sense for us to bring that in-house. Again, the Trius way, slow and steady, conservative, be smart. I don't want to jump into management because we think we should do it and we want to be cool and we want to have full control from day one. It's not smart financially, and we don't have as much knowledge and experience on it. So we're going to work our way in and phase in slowly, staff up that team slowly, and make sure it makes economic sense to say we're paying X per property and X per month. Once we're big enough and have enough scale, hey, I could hire the 2 people or 3 people or 1.5 people or what have you, and we can manage this ourselves with a team that we'll build out ourselves. So we will do that when the time is right. The costs for that does come out of the fund. So the fund essentially is one main, if you've owned your own real estate, your QuickBooks account for that property, it's that just on steroids because it's going to have all the properties. So in that fund is all the accounting costs, all the servicing, the maintenance costs, all the repairs costs, all the management, et cetera. Obviously, we have better access, we believe, to less expensive trades, less expensive vendors for rehabs, deals on appliances. I know 4 cabinet and supply guys off the top of my head that I'm personal friends with. We've known for years and we work with for years. So we have a lot of connections for people to do this less expensive. So we believe we're getting a much better bang for the buck on those expenses. But all those expenses are there, and all those expenses will be shared and broken out on financials for the fund. Here's what we brought in. Here's what we bought. Here's what we had to renovate on this property. We had to buy a stove here, redo a countertop here, or a cabinet there. Again, generally speaking, not major renovation. And here's what's left off at that point, and here's what the profit is for everyone to share in at the end of the day. So I hope that answers the question, Ari.
And
Yeah.
yeah, if I may just jump in, two things, in their kind of more detail, but of course, those same costs are included in the initial underwriting, right? So obviously, property management, to Josh's point, economies of scale. If you own one rental home, you probably have a cost, or you should at least be charging yourself if you're, managing it yourself. But there's a cost to property management if you own 10, if you own 100. But as you scale up, obviously, of economies of scale. Second, in terms of like the nitty gritty of like actual, hey, what's the exact specific, management kind of percentage and all of that. If you're really interested in investing with us, which would be awesome, we can also send the private placement memorandum and subscription agreement. And those are really the legal documents that support this fund
Yep.
and really outline the specifics of, associated
Very
management,
detailed.
costs and percentages, and clearly, and I can even highlight those
Yeah.
for anybody and take
Let
you
me,
straight to them.
yeah, and let me jump in just back to one other aspect of that on the conservative nature of the underwriting we're going to do, and we're underwriting properties we're going to buy. When we're looking at, so we are going to do some Section 8, which is sort of the subsidized type programs, which can be popular in our region. And if you're not familiar with those essentially guarantee that you're getting a payment every month, no matter what. Those programs also have the tenant contribute a portion as well, depending on where their income level is and how much they can afford. One example of our conservative underwriting is we're underwriting those types of properties. We're not going to even count the tenant contribution. We're going to underwrite it at a more conservative basis based only on the guaranteed rent, and anything else to be icing on the cake, right? That's just like a plus for us. But again, we want to look at everything in a more conservative way. So we intend on having pretty good balance between both. We do not want to have all of our eggs in one basket in just independent tenants, nor in Section 8. We want to have a good balance of both. I've seen firsthand people have incredible success with both. I've seen firsthand people have incredible lack of success in either one. Section 8, specifically speaking about it, there are people that we know, again, have known for years, who are specialists in managing Section 8, expertise in bringing in tenant placement for Section 8, experts in the inspections for Section 8. So there are experts for all these things. I've known them. We've worked with them. We know who they are. We have personal relations with them. That's, again, the benefit of working with someone where you're not having to start from scratch and make all these relationships, have to make these mistakes. We have, and our clients have, who have flipped properties, bought properties, done holds that we have financed. They've learned some of these mistakes, paid for it. We've learned some of these mistakes, paid for it. That doesn't have to be passed along to our investors. That's the best part at this point in our business and in where we are sort of in the local marketplace and in the industry, that the fund and us as the managers of the fund have the experience to say, hey, we've learned all those lessons. And the other thing, when you talk about other sort of expenses and costs, I mentioned this briefly, our staff, right? I don't have to hire a full-time bookkeeper, for example, for the fund, right? We have on staff a team of 4 people in our bookkeeping accounting department, right? So I don't need a full-time person to do this. We may never need a full-time person to do this. We can allocate a portion of one of the 4 people we have on the team, and they're a portion of their time when needed and as needed. So we don't have to have fixed costs that will impact and reduce the profitability of the fund. So we think it'll actually be the opposite. We'll be able to keep a lot of those costs very much lower and better in control than someone else starting this from scratch that would need to hire a Jessica full-time, a Josh full-time, an accountant full-time, an analyst full-time. We have a lot of those players that we can allocate portions of time as needed. And if they need to be full-time and we need to bring on more people, we absolutely will. But especially in the growth phase of it, we can keep those costs very low, and that'll help the overall return on everything.
Last question. What is the minimum to invest if you don't have enough to buy one house? You want to take that or you want me to?
Sure. Yeah. Yeah. I'm not sure if you're specifically talking within our fund or just doing your own real estate investing. Obviously, we work with both. I'll answer the real estate investing side too. So if you're looking to invest in real estate and buy your own properties, flip your own properties, and or hold your own properties, we generally say you're going to need 30-ish, $40,000 to buy a property, and we would fund the rest on the lending side that we do. If you're referring to investing with us, the minimum is $100,000. That is the minimum threshold for investing into the rental fund, $100,000, and there's no maximum. So bring it on. We're ready. But a minimum $100,000, and we are going to again put all that money together and then use that money to buy those properties as we come into those opportunities for doing that at that 50% loan to value that we talked about a few minutes ago. So I hope that answered the question. If it didn't, please retype and let us know here. One more question here, and feel free to ask some more. We're happy to stay. Will we be buying single family or row houses or both? It's all of the above, right? Not multi. So we're not buying towers, right? So we're staying in it's sort of its own category in real estate investing, the 1 to 4. So single family, standalone. It might be a row home in Philly or Baltimore, who knows what, or in Baltimore County or DC or Virginia, whatever it might be. That'd be a row house. A townhouse, which is a little different from a row house, okay? Or any mix thereof. So that would be what we're doing. We're going to be doing. He's asking, city or county. We're going to be doing broader than that. So our focus is not Baltimore City. Okay, I want to be clear about that. Having said that, we do business opportunistically when we see opportunities in city. We do in the city, and there's some great areas that are very profitable and very lucrative in Baltimore City. We love Baltimore County. We want to do more in Baltimore County, but all of the counties in Maryland will be in play, and we intend on having a good, diverse portfolio. So again, diverse footprint of the portfolio, very important to us. Again, some Philly, some suburbs of Philly, some Harrisburg, York, some Baltimore County, some Baltimore City, some Western Maryland, some Harford County, okay, some Montgomery County, okay, so all around Maryland. Heading into DC, very selectively, it can get too expensive in DC, so I'm not sure where we'll find opportunities there. Northern Virginia gets challenging again, very costly, so tough to find that cash flow on a rental side. But once you get out of Arlington, start to head down, Richmond for sure, and where Jessica, as she mentioned, has experience, Hampton Roads, Virginia Beach, that sort of whole area there. Great opportunity. We think there's good bang for the buck in that neck of the woods. So we think that'll really work well for us as well. Eastern Shore, I see a question there. So Eastern Shore on a case-by-case basis, we're not against it, but I will say we're not looking for rural properties. So if we did something Eastern Shore or heading out toward the beach area, for those of you familiar, there's sort of a patch of area in the state of Maryland heading toward the Delaware beaches and the Maryland beaches, which can be very rural. We don't intend on doing much in a rural area, but Easton, Maryland, for example, Easton is a pretty nice sized town. There's a lot of activity there. We would be open to looking at rentals there if we thought the bang for the buck made sense, and the cash flow and return made sense. The more rural areas we probably wouldn't do, but then if you went over to the beach areas, Lewis, Rehoboth, Bethany, Ocean City, not looking to do short-term rentals. I want to be clear about that. But the areas that are 20-25 minutes outside of the beach are areas where people are living and having lives and working. And there's some opportunity there as well. So we would not be against that. I will tell you, we're not focused on that, but we would not be against that at all. Our focus is, because we love this area so much, the Mid-Atlantic, the in the old days it was commuting to DC. Now it's just being remote work to DC. But regardless of political party, regardless of affiliation, regardless of what happens in 20 days, I can guarantee you one thing: our government will continue to grow. Whether you like it or not, and whether I like it or not, it will happen. It will continue to grow. All the fields and all the sectors will continue to grow. The consultants, the lobbyists will continue to grow. The high tech and the people who support the consultants and the law firms, they'll continue to grow. It's been happening I've been in this area for 25 years. I've talked to people who've been here their entire lives. It just is part of what happens. That's part of DC. So we love this area. We also love proximity to the ports, which is Baltimore is a huge port area, and then proximity to Philly and proximity to New York. So we're in such a great area. There's a big real estate investor in town. I went to hear him speak recently, and when he said, you know, the sort of northeast corridor from Boston to DC is waterfront, which is phenomenal. And as we all know, they're not making any more waterfront right now. And he said, if you look at the neighborhood, he was talking about the northeast corridor as the neighborhood. He said there's one area that sticks out as being incredibly affordable and has really upside opportunity more than any of the other areas. And that, of course, was the greater Baltimore region, right? Boston's pretty well developed, heading down through Connecticut, for sure, New York, New Jersey, right? You're not going to find great deals there. There's opportunities there, but not great deals there. As you head further down, Philly's pretty robust, but some similarities to Baltimore. But Baltimore still has a little bit of this rugged feel, and it hasn't gotten and been given the credit it should be given. Johns Hopkins, the hospitals, the education, the universities. I can go into all that stuff. The Ravens are doing well, the Orioles, but there's a lot of opportunity here, and it's sort of an under the radar type of opportunity, and that's what we love about it. And then, of course, DC is pretty well developed as well. So that's his thesis in doing a lot of investing in this region. Some more questions. What do we got, Jess?
Would investors get regular income and expense reports? Short answer, yes.
Yeah, absolutely.
Yeah, that's a short answer. So answer is yes. Interest for this would be paid quarterly. If you've invested with us on the debt fund or on an individual note, you'll know that you get paid monthly on those. This would be quarterly. So that is one difference. The target IRR, is that on an annual basis or the entire hold period? So that is the hold period. And that's really the life cycle. And that is, we're talking economies of scale, but it's the same life cycle you experience if you just buy one single family rental. That very first year, you're stabilizing it, you're making sure the tenant's good to go, doing any small repairs you might need to do. And then, as the years go on, you're able to increase rents, and you've stabilized. And then, of course, that continues until the capital event. The capital event appreciation is obviously a big factor that, to Josh's point, when we're doing underwriting, we are, I think, the Case-Shiller index since 1978, don't cite me on this, sources cited, but I think it's about like 4.7, 4.8% since
correct.
1978.
Yep.
We are not using that. So when we underwrite our stuff, we're using 3 to 4% just to be really conservative. It's kind of just interesting for y'all to know. But that end IRR, target IRR of 14 to 17%, that is based on the entire hold period to include that capital event for sure, which is going to juice the returns. Appreciation.
So just to be clear, that's at the end of the day, when you look back, that's the annualized rate of return through each of those years, even though you didn't get it on the first maybe year or whatever it might be. But when you look at it, at the end of the day, your pot of gold or your bank account will have the equivalent of that 14 to 17% annualized rate of return at the end of the day. But it's a little bit back-loaded, back half, back third, whatever you want to call it, which is how real estate always works. Just to be clear on that, happy to take that offline with anyone as well. Yep.
The next was a K1 question about depreciation on individual taxes.
Yeah. Again, I'm not a tax professional. I'll never pretend to be one. Consult your tax professional as well, and happy to set up calls. We have actually hopefully one set up in the next week or two with our CPA firm, talking about the depreciation, digging into it a little bit deeper with someone. It's not actually all that complicated, but we're happy to offer that up. Essentially, yes, the same depreciation you get proportionate to you will be on your K1 shown as depreciation that you then apply to your personal taxes. So the answer is yes. You get the benefit of depreciation. If you're not clear on depreciation, again, offline conversation, happy to dig into it. Essentially, it's a tax benefit, a tax savings, which allows you to be in a better financial position, make more money, earn more money, and pay less taxes by owning real estate. You will get that as an owner, same as you would get if you bought your own property. So if you go out and buy a property tomorrow for the same $100,000, okay, you're going to get depreciation. You're going to get hopefully long-term return, but you're going to have the sweat equity that you won't have with us. Now, the question is, how much more money will you or won't you make? I would argue we're going to, I think, do better than the average Joe all day long, okay, without the sweat equity part, right? So I think we can do better without having to do it. But we've all seen, Jessica mentioned as well, and we see this every day. For every day I've been in this business, the people who are like, it's a grind. I spent all weekend visiting properties and having to get this one redone, and meeting with my manager, and having an issue with the tenant, and having an issue with BGE that they didn't hook up the electric or they canceled it. We had someone recently who, a borrower who was borrowing money from us, their neighbor was stealing the electricity from their tenant. So they were getting these electric bills that were double what they should be. Well, because the person was stealing it. That's not so easy to work through. It's a pain in the butt. But those are the kinds of things that this person was like ready to pull their hair out, and I don't blame them. But for us, that's like another day at work, right? But for someone who has maybe a full-time job doing anything, you're like, I don't want to deal with this stuff. I want to go home, hang out with my loved ones and my family, and watch a little Netflix and go to bed. And so that's the difference of your ability and willingness to handle it. I had dinner with someone last night who was like, I've been dying to get into real estate. He's like, I just don't have the time. I said, that's exactly why we're doing this. So,
Fun fact, I never told you a story that happened to me on one of the flips you guys funded. And
oh yeah,
I had a
yeah,
$900 bill for electricity. So
yeah.
I
They
can
just hook it
also,
right in. Yeah, they're slick.
oh,
Yeah,
it
yeah,
was
yeah. We've
lovely.
seen
I
that with
felt,
water and with
yeah,
electric for sure. Yeah.
really made my
Another
day.
question here.
Yep. This is the last
Um,
one we've got so far.
Regarding the previous question, depending on the type of investment, is it possible to roll origination fees into the loan for beginner investors with little, low or no capital? How would you work with beginner investors with lack of funds experience? So this is regarding us lending money to you. Happy to talk about that.
Mhm.
Essentially, the long and short of it is we always require skin in the game from our borrowers. So we don't roll in those fees and costs. Definitely a conversation we can have. And again, our very sort of transparent upfront approach is, let's look at your financial situation. Let's see how to make this work, right? I don't want to sit here and make promises or guarantees one way or the other. I can tell you, you need to have money to invest in real estate, period. And real estate is a business. Investing in either one property or two properties, that is starting a business, starting a company. It is a big deal, and it needs you to put money in to do it. I would caution anyone against doing zero in, because you don't have skin in the game. You don't have any equity in the game. I don't think that's smart for anyone. Another conversation for another day. But would happy to talk with you about how to save funds, how to access funds. There are gap funders. There are ways to do it. So please do reach out to us. And I'm just making a note
Yeah.
here to try to reach out to you as well, so we can have one of our guys, one of our people on the team here, help you out and sort of walk you through that. Any other questions? We've covered an hour. I see some people starting to jump off. Thank you all for joining us. I think we've covered the
Yes.
questions. We really appreciate the time. We really appreciate the questions. We had a great back and forth here, which was awesome. Um, Happy to help answer any questions. Happy to have one-off conversations, one-off meetings. Happy to explain anything more in further detail. We will be following up with emails. We will be reaching out, and we hope to have you participate and become a member and an investor in our rental fund. We think we're going to have a good time and make a heck of a lot of money, which is what we're all here for and here to do. And we think it's going to be really an exciting ride. We think the timing is great to really have an incredible upside opportunity on making a really nice, healthy return investing in real estate. So until next time, have a great night. Thank you.
Thank y'all. Thank you.
Bye-bye.